Welcome back to the portfolio, everyone. And today we're going to talk about Disney. They just released their latest earnings report. They announced that they are suspending their next dividend payment. We're going to take a look at the price chart of Disney. We're going to go through some key points of that earnings report. Then we're going to take a look at their financial statements on the earnings report and determine whether or not Disney will survive, if they're going to go bankrupt, or if it's time to buy the company. But before we take a look at Disney, we're going to jump into my portfolio. So the current portfolio is sitting at a value at $32,916. We saw a nice modest gain on the day, just over 0.22%, around $70 in the green for this single day. But overall portfolio is still in the red, down over $5,500, which equates to over 14% down in the red on this portfolio overall. Of course, we are a long-term investor, so this short-term drop in price doesn't affect the portfolio too much, and we're going to continue to contribute and continue to grow it moving forward. Before we jump into Disney stock, I am going to ask that you please like and subscribe. It really does help my channel grow, and I really do appreciate everyone who does that. So we take a look at Disney's price chart here. Of course, the stock price is not the only thing you should take a look at, but we're going to start here. On the 6-month chart, you can see here, Disney was trading at a nice value around $145, $140 a share. Then if we look at the year-to-date chart, it has been all downhill. So we all know what's going on in the world, which has caused Disney to shut down some of its main revenue streams, and the stock has been hammered for it. Year-to-date, the stock is down over 32%. And of course, with this large decrease, there's reasoning behind it. Disney has had to shut down a lot of its major revenue streams, such as their parks and theme parks, of course, which makes the future revenues uncertain and future income for the company up in the air. So this has led to such a huge decline in the price as long as the overall market. So of course, down 32% year to date. And now we're going to jump over to this nice article from CNBC, which talks about some key points from the earnings report, and then we're actually going to dive into the earnings report issued directly from Disney and take a look at some points from them read in the earnings report itself. So right here, this says Disney reports 58% drop in operating income from Parks and Cruise Line, its worst hit segment. So some key points of the article here is that Disney reported mixed results in Q2, and we're going to talk about why the results were mixed. And of course, we all know that the Disney theme parks and cruises have been shut down right now, so the company is hoping to boost earnings through some of its streaming services such as Disney+, ESPN+, and Hulu. And this was the first earnings report with their new CEO after Bob Iger stepped down from his role last February. So if we take a look here, you can see what Disney reported. So Disney reported earnings per share adjusted for comparability at 60 cents a share. Estimates had them earning 89 cents a share. So they did miss on estimates, and they did see a sharp decline in earnings per share. But of course, what made this result a little bit mixed was that Disney actually beat on revenue. They were expected to do $17.8 billion of revenue, but they actually brought in just over $18 billion in revenue for this quarter. And of course, that increase is actually a significant increase compared to last year's Q2. We will take a look at that when we look at the actual earnings report directly from Disney. But a couple good points I want to point out here was that, so of course, the suspension of the dividend, which is a key factor for a lot of people who invest in companies. Some people really believe in dividend income, whether the dividend may be large or small. Some people believe that dividends are extremely important and that companies must be paying a dividend if they want to be part of that individual's portfolio. So the fact that Disney has suspended their next dividend payment is very important to a lot of people, so we're just going to touch upon that here. So the CFO, Christine McCarthy, said, the move would preserve $1.6 billion in cash, assuming the dividend held consistent at 88 cents per share. So because they are suspending that next dividend payment, Disney will not have to pay out that $1.6 billion, keeping that cash within the company to use to maintain operations during this time of uncertain revenue and uncertain earnings moving forward. Total operating income this quarter was $2.42 billion, down from $3.82 billion from this quarter of last year, which is a 37% drop. So of course, they aren't mentioning what they're going to do with their next dividend payment in the future because they did pay a semi-annual dividend. That dividend is more than 6 months away, and they said they will address that when it gets closer to that date. And maybe by then they'll have more information about whether or not their parks will reopen and their cruises will reopen, and then they can determine whether or not they have the ability or it's best for the company to pay out that dividend in the future. So if you are a dividend investor and you value companies who pay their dividends consistently, Disney might not be the best company for you right now because they have suspended their dividend and the uncertainty of their next dividend is still up in the air. So another key point that I really want to talk about here. So Disney spent about $1 billion. They lost around $1 billion due to a lot of these closures. The company reported a 58% drop in operating income for the parks, experiences, and products segment this quarter, like compared to last year's quarter. Another key point here that I thought was very interesting to see is that there are some bright lights ahead if we are able to everyone stay safe and keep park safety priority. Disney's actually planning to open their Shanghai Disneyland on May 11th. So this is going to be a phased approach. So typically this park had over 80,000 people per day, but the government said they max can operate at 30% capacity or 24,000 visitors. But the company, something I like to see from Disney is that they are not opening up and allowing all 30,000 people in at once. Disney is actually going to take a staggered approach where they're going to gradually let in more and more people each day over several weeks. So instead of opening up their doors on the first day and allowing 30% capacity all at once, they're going to slowly increase capacity over a couple weeks to ensure that they are continue operating safely and gradually improve operations over that time. Couple key points I want to touch upon here before we jump into Disney's actual earnings report is how their revenue is broken up this quarter. So you can see here, media networks brought in $7.26 billion, which was up 28%. Parks, experiences, and products brought in $5.54 billion, which was down only 10%. But what you have to understand here is a lot of Disney's theme parks didn't get closed to the end of this quarter. So they did operate for 1 or 2 months of this quarter. So that's why this number wasn't as large of a drop as some people were expecting. Of course, this next quarter moving forward, if a lot of their main Disneyland parks and theme parks are shut down, this number may drop by a more significant amount on their next earnings report. Studio Entertainment brought in $2.54 billion, which was up 18%. And Direct-to-Consumer and International brought in $4.12 billion, up more than 100%. Of course, Direct-to-Consumer is some of their Disney Plus products, their streaming services, which are very new to the company and weren't actually like a big part of their revenue stream before. So that's why we saw this huge jump of more than 100%. If we jump over here to Disney's earnings report, this is directly from Walt Disney itself. This is their earnings report they released, and I highlighted some key points. So of course, this is what the article was talking about before, but I wanted to talk about it directly from earnings report from Disney. So excluding certain items affecting comparability, diluting earnings per share for the quarter decreased 63% to 60 cents a share from $1.61 per share in the prior year quarter. So they saw a 63% drop in earnings per share, which is a very high drop. That is something you don't want to see within your companies, but of course we understand why it's happening to Disney, and it is something that is currently out of their control, which is tough to see, but there's nothing they can really do about it at this moment. And we're going to take a look at some of their yearly quarter changes. If we take a look here, the same quarter last year in 2019 brought in $14.9 billion of revenue, but this quarter in 2020 brought in just over $18 billion of revenue, which is actually a 21% growth in revenue from quarter to quarter. If we take a look here at the diluted earnings per share, of course, this is what that first line in that article just said. This quarter had 60 cents earnings per share. Same quarter last year reported $1.61 per share earnings, which was a drop of around 63%. So another thing we're going to take a look at here in their earnings report is their financial statements. So we're going to take a look at their income statement first, which once again, of course, represents that 21% growth in revenue quarter year, from last quarter, this quarter last year to this quarter this year. You see here the $14.9 billion up to the $18 billion this year. But of course, we take a look at their net income. Net income of this quarter last year was at $5.45 billion. And net income for the same quarter this year was just at $460 million. So they saw a large decrease in net income. Because of what's going on, we all understand what's happening, and they are continuing to spend money to maintain their operations, although they aren't bringing in the revenues from some of their major revenue streams. If we move down here, we're going to take a look at their balance sheet right now. And during these times when income and revenue streams are somewhat uncertain, we want to make sure companies have enough assets to pay off their liabilities in order to maintain their business operations and continue to hold strong and hopefully reopen and reach full capacity once again in the future. So if we take a look here, some important parts right here is that Disney's current assets are around $33 billion. So what you want to take a look at here is that they need to make sure they have enough current assets to pay off their current liabilities. So it's nice to see that their current assets have grown year over year, but now we want to make sure that their current assets of just over 33 billion can pay off their current liabilities. So if we scroll down here, you can see they have current liabilities at around 35 billion, just over 35 billion. So they do not have enough current assets on hand to actually pay off their liabilities, but the fact that that number is very close to how much current assets they have, I am not too worried about their short-term financial health. They aren't in the best position, but they are not in the worst position by all means. They are close to having a current ratio of 1, which is their current assets divided by their current liabilities. So the company will be able to maintain operations within the short term, within the next year, and will be able to continue to operate hopefully moving forward, and hopefully they can get past all of this. I did take a look at how their total assets compared to the total liabilities, and of course they do have enough total assets of over 200 billion to pay off all their short-term and long-term debt if needed be. So they do have enough assets to cover their liabilities. Disney is different because they do have a lot of intellectual property, which does have a value that may not transition directly to cash. But of course, if you really want to take a look at this company, you have to do a deep dive on all their financial statements. This is just an overlook view of how their earnings report issued today really impacted the company. So of course, we're going to end it by jumping back into my portfolio, where I thank you for tuning in. I do appreciate everyone who watches these videos. I'm the Gen Z investor, and today we talk about personal finance and investing. I do promote videos 3 times a week on Monday, Wednesdays, and Fridays. So if you want to take a look at one of my future videos, please like and subscribe. I really do appreciate everyone who does that. Thank you.